August 1930, Omaha, Nebraska. Warren Edward Buffett is born right into the teeth of the Great Depression. He grows up watching adults worry about bills, jobs, food, and survival. And while other kids are thinking about toys, young Warren starts studying something much darker. What happens when a family does not have money? This is the first clue to understanding Buffett. He was not just interested in being rich, he was interested in security, control, freedom. Money was not a toy to him. It was a scoreboard, a shield, and eventually a language he wanted to master. At just 7 years old, he finds a library book titled 1,000 Ways to Make $1,000. For most kids, it would have been a boring book. For Buffett, it was a treasure map, a manual, proof that money could be studied, earned, multiplied, and controlled. And he does not wait. He starts knocking on doors, selling chewing gum, magazines, and Coca-Cola. The numbers were tiny, but the lesson was huge. Buy low, sell higher, track the profit, repeat the process. Buffett was learning capitalism before most kids learned long division. By age 11, most kids are buying comic books. Buffett has saved $114.75. Then he makes his first stock market move. 3 shares of Citi's Service. Preferred at $38.25 a share. Almost immediately, the market tests him. The stock falls to $27. He sweats. He waits. Then it climbs back to $40, and he sells for a small profit. He thinks he has won. Then the stock rockets above $200. That mistake burned into his mind forever. He made money, but he learned the bigger truth. Selling too early can be just as painful as being wrong. The lesson was brutal. Impatience is expensive. Sometimes the real money is made after your emotions tell you to leave. When his father is elected to Congress, the family moves to Washington, D.C. Buffett does not slow down. At 14, he works multiple paper routes at the same time. This is not just a teenager delivering newspapers. This is a kid building a logistics operation before he can legally drive. The money starts stacking up. He buys a 40-acre farm in Nebraska with $1,200 from his savings. Think about that. While other teenagers are spending their money, Buffett is buying productive assets, land, cash flow, ownership. Then he buys a used pinball machine with a friend for $25 and installs it in a barber shop. The quarters roll in. They add more machines, then they sell the business for $1,200. Buffett is not just hustling anymore, he is learning scale. By the time he finishes college, Buffett has saved $9,800. Adjusted for today, that is roughly $180,000. He has discipline, he has capital, but he still needs the one thing that turns hustle into compounding: a system. That system begins with Benjamin Graham. Buffett discovers Graham's book, The Intelligent Investor, and it changes his brain. Graham does not teach him to chase hot stocks. He teaches him to think like a business owner, buying pieces of companies at bargain prices. Graham's idea was simple but powerful. The stock market is not a wisdom machine. It is a voting machine in the short term and a weighing machine in the long term. Prices can panic, people can overreact. But value eventually matters. This is where Buffett learns the foundation of value investing. Do not buy a stock because the chart is moving. Buy it because the business is worth more than the market thinks. The gap between price and value becomes his hunting ground. Graham also gives him a second weapon, margin of safety. If a bridge can hold 30,000 pounds, you do not drive a 30,000-pound truck over it. You demand a cushion. Buffett applies that idea to investing. This is what separates Buffett from gamblers. A gambler asks, "How much can I win?" Buffett asks, "How much can I lose if I am wrong?" That one question changes everything. It forces patience, discipline, and humility. Buffett wants to learn directly from Graham. So he applies to Columbia Business School after Harvard rejects him. That rejection could have felt like failure. Instead, it sends him exactly where he needs to be. At Columbia, Buffett absorbs Graham's framework like a machine. He studies balance sheets, earnings, assets, debt, and liquidation value. He is not looking for exciting stories. He is looking for situations where the numbers are screaming and the crowd is asleep. After school, Buffett works for Graham Newman. He sees the method in action. Buy neglected companies for less than they are worth. Wait, let value close the gap. It is not glamorous, but it works. But Buffett is not just copying Graham. He is evolving. Graham loves buying cheap assets. Buffett starts asking a deeper question. What if the best investment is not just cheap, but so good that time itself becomes your ally? This evolution becomes clearer when Buffett meets Charlie Munger. Munger pushes him beyond cigar butt investing. Do not just buy awful businesses because they are cheap. Buy wonderful businesses at fair prices, then let time do the heavy lifting. That shift is enormous. A cheap bad business may give you one good trade. A great business can give you decades of compounding. Buffett begins looking for companies with durable advantages, pricing power, strong brands, and managers he can trust. This is where Buffett's famous moat idea comes from. A castle is valuable if competitors cannot easily attack it. In business, the moat can be a brand, a cost advantage, a network, customer loyalty, or simply a product people keep buying again and again. Buffett does not want businesses that need constant miracles. He wants simple businesses with economics he can understand: insurance, candy, newspapers, banks, consumer brands. Companies where the cash flow is boring, predictable, and powerful, and this is the part ordinary investors miss. Buffett's genius is not that he predicts everything, it is that he avoids what he does not understand. He builds a circle of competence, then refuses to step outside it just because something looks exciting. This discipline makes him look boring during bubbles. When everyone else is chasing the hottest new thing, Buffett often looks old-fashioned. But that is the trick. He is not trying to look smart today. He is trying to be solvent tomorrow. In 1956, Buffett returns to Omaha and starts Buffett Partnership. He is not managing billions yet. He is managing money for family, friends, and local investors. But the rules are already clear: protect downside, find value, and never confuse activity with intelligence. The partnership performs incredibly well. Buffett buys obscure, unpopular, mispriced securities. He does not need applause, he does not need headlines, he needs facts, patience, and a market that occasionally loses its mind. Then comes Berkshire Hathaway. At first, it is not a legendary holding company. It is a struggling textile mill. Buffett buys it because it looks cheap. But soon he realizes something painful. Cheap does not always mean good. The textile business is difficult. Competition is brutal. Returns are weak. Capital keeps getting swallowed. Berkshire teaches Buffett one of his most important lessons. A bad business can consume good money for a very long time. But instead of letting Berkshire die, Buffett transforms it. He turns the struggling textile company into an investment vehicle. Over time, Berkshire becomes less about fabric and more about float, insurance, cash, and owning pieces of great businesses. The secret engine is insurance float. Berkshire's insurance companies collect premiums today and may not pay claims until years later. That money can be invested in the meantime. Float becomes low-cost fuel for Buffett's compounding machine. This is not flashy. It is not a trading app. It is not a secret indicator. It is structure. Buffett builds a machine where patient capital flows into productive assets, and those assets send back more cash to be redeployed again and again. That is compounding, not magic, not luck, a machine. Money earns money, then that money earns more money. Then time does what time always does for the disciplined. It turns small advantages into ridiculous outcomes. Buffett's real superpower is not speed, it is duration. He understands that a good decision held for decades can beat 100 clever trades. The world chases movement. Buffett chases time. Look at the pattern. Coca-Cola, American Express, Geico, See's Candies. These are not random trophies. They are businesses with brands, habits, trust, distribution, and pricing power. Buffett is not buying tickers. He is buying economic behavior. When people keep buying the same product for years, that is not just sales. That is habit. When a company can raise prices without losing customers, that is not just branding, that is power. This is why Buffett loves simple businesses. If you can understand how money enters, why customers stay, and what keeps competitors away, you can think clearly. And clear thinking is rare in markets designed to create noise. Another piece of the Buffett formula is temperament. Most investors do not fail because they cannot do math. They fail because they cannot control themselves. They panic when prices fall and become reckless when prices rise. Buffett built a career around doing the opposite. Be fearful when others are greedy. Be greedy when others are fearful. That sounds simple until the market is crashing and your stomach is telling you to run. This temperament shows up during crises. When others desperately need cash, Buffett wants to have cash. When fear is everywhere, he wants options. That is why Berkshire often looks conservative before a crisis and powerful during one. During the financial crisis, Buffett invests when confidence is broken. He does not buy because the news is good. He buys because the price, terms, and long-term value finally make sense. Panic creates the discount. Discipline decides who can use it. That is the difference between Buffett and most investors. Most people want certainty first and a bargain second. Buffett understands that the bargain usually appears when certainty is gone. But none of this works without patience. Buffett is not trying to win every week. He is not trying to impress strangers online. He is playing a game where the reward goes to the person who can stay rational the longest. This is why his wealth exploded later in life. Buffett was not a billionaire at 30. He was building the base. The compounding curve looks boring for a long time. Then suddenly, the line bends upward and people call it genius. But the truth is less glamorous. He did the same sensible things for an unusually long time. Save, learn, buy carefully, avoid ruin, reinvest, wait. Then wait longer than everyone else. That sounds easy, but it is not. Simple does not mean easy. Eating healthy is simple. Exercising is simple. Saving money is simple. But the hard part is doing the simple thing consistently while the world tempts you to quit. Buffett's life is a case study in focus. He reads, he thinks, he waits, he says no constantly. And because he says no to almost everything, he has the capital and mental clarity to say yes when it truly matters. This is one of the most underrated parts of investing, opportunity cost. Every dollar you put into a mediocre idea is a dollar you cannot put into a great one. Buffett protects his capital because he knows great opportunities are rare. And this is why he avoids debt. Debt can make you look smarter in good times, but it removes your ability to survive bad times. Buffett understands that if you avoid ruin, time remains on your side. So when people ask how Buffett became the world's greatest investor, the answer is not one secret. It is a system, value, quality, patience, temperament, cash, compounding, and the discipline to repeat the process for more than 70 years. The public version of Buffett is almost too simple. The old man with a Coke, a smile, and a folksy quote. But underneath that image is one of the most ruthless filters in financial history. He ignores almost everything. He ignores hype. He ignores status games. He ignores complicated products designed to make simple people feel sophisticated. His question is always the same. What is this business worth? And can I buy it for less? That question is boring. But boring is exactly why it works. Markets are full of people trying to feel brilliant. Buffett built his empire by trying to avoid being stupid. And maybe that is the real genius, not predicting the future perfectly, not finding the next miracle stock, but building a life where good decisions are repeated, bad decisions are avoided, and time is allowed to do the heavy lifting. Buffett's story also destroys one dangerous myth, that investing is about constant action. His career proves the opposite. The biggest money often comes from inactivity after the right decision. Buy well, hold long. Let the business work. For ordinary investors, that lesson matters. You do not need Buffett's brain to copy the principle. You need patience, savings, rationality, and ownership of productive assets. The formula is simple. The hard part is staying with it. That is why Warren Buffett became the world's greatest investor. Not because he never made mistakes, he did. Not because every investment worked, it did not. But because his system survived mistakes, avoided disasters, and let winners compound for decades. The secret was not speed, it was not prediction, it was not charisma, it was behavior. And behavior repeated over a lifetime can become a financial superpower. So the next time the market gets loud, remember Buffett's quiet lesson. You do not have to swing at every pitch. You do not have to chase every trend. You only need a few great decisions, protected from impatience, given enough time to grow. That is how a boy from Omaha, obsessed with nickels, newspapers, farms, and pinball machines, became the greatest investor in the world. He did not just learn how to make money, he learned how to let money work for him longer than almost anyone else alive. What do you think? Was Warren Buffett's success pure genius, extreme discipline, or the greatest example of patience in financial history? Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of how Warren Buffett became the world's greatest investor, then you'll love the story of how Enron fooled the world until everything collapsed. Click the video on your screen now. I'll see you there.